Good day, Spartans. Happy Wednesday, April 12th, my last day in Phoenix, Arizona, the land of the rising sun. It's time to lock in, fire me up. You can see the agenda today. We are talking about bonds. Whatever time you have left, you are getting into your investment groups and you are spending an additional $50,000 from your portfolio's capital, right? So we spent $20,000 last week on top of the $1,000 before spring break. So then that would put you at 1 plus 20 plus 50, at least $71,000 should be invested. And you do have a securities research form to complete with every purchase you make. Again, it is the same securities research form you've used before. One person per group needs to fill this in. Make sure your names are written across the top. But again, I get ahead of myself talking about this, mostly because I'm distracted watching the Masters in a window that is not being shared with you right now on my desktop monitor. But let's get into it. Let's talk about bonds. A bit of a review. We've already talked about bonds before, but it is an important security to have some money in. Now, obviously, bonds do not pay the same interest check that. Bonds do not have the income return as high as stocks do. The nice thing about bonds is they provide a steady amount of income. And if we're following that drip plan that we talked about, it is a nice way to get ourselves some income concurrently right now, whilst owning them, and then reinvesting that money into the market, maybe into bonds, maybe into stocks, but it allows us to put our money to work faster and allows us to get more money invested. That isn't necessarily money coming out of our paycheck. This is money coming out of our investments that go right back into investments, getting us more money in the future. Just to review, bonds, right? They can be corporate bonds, Target issues bonds, Caterpillar issues bonds, Polaris issues bonds, Amazon issues bonds, companies issue bonds. The Treasury Department, the government issues bonds, right? There are bonds that were sold to build U.S. Bank Stadium. School districts, cities sell bonds to raise money to pay for new buildings, new roads, whatever. We need to understand that a bond is a loan. And the reason why bonds pay less in regards to income return is the fact that you get your money back at the end of a loan. You take out money from the bank, you borrow money from the bank via a loan, you pay the money back. You pay the money back plus interest. These are safe. Now, typically, we get heavy into bonds. Typically, investors get heavy into bonds. Perhaps when the market is bad, right? They take their money out of the stock market, they shift it to bonds where it's guaranteed, almost guaranteed. They shift their money into bonds when they're near retirement, right? When we did a little portfolio simulation, right? People who are older, people who are near retirement, they're going to be in bonds because their money is safe. They probably already made their money, their retirement money while working earlier in their career. Now they're just in protection mode. Bonds are where we go for protection. All right. Again, they're issued by governments, by state governments, city governments, national governments, the United States, corporations, as a way to raise money. And it is a way to raise money without having to take on, owners who want to have a say in what the corporation is doing. There are some terms that we need to know. All right. Par value, face value, or principal. This is simply the amount of money that you have loaned to a corporation, to a government, to a school district, whatever. But it is the amount of money that you have loaned to them. Typically, the principal, the par value, the face value of any bond is $1,000. Typically, these things are sold in $1,000 increments. So you buy 10 bonds, $10,000, right? The par value, the principal, the face value is typically $1,000. Every bond typically Typically, every bond comes with an interest rate or a coupon rate. Why they call it a coupon rate versus interest rate, I don't know. I don't make the rules. I just teach you about it. That is the interest that is being paid. Now, there are some bonds that are called zero interest bonds, where you're not getting money each month, or you're not getting money each quarter or each year. You just get your money at the end. So maybe you buy a $1,000 bond at 10% at 0% interest, but that $1,000 bond only costs $900. So you get your $100 or 10% once the bond matures. Which brings me to my next term, maturity. Maturity is when the loan is due. It is when the bond is due. Some bonds have a year maturity. Some bonds have a 10-year maturity. If you're in government bonds, they have a 30-year maturity. But it is just the length of time that the money is loaned to some institution. Again, corporate, government, municipal, what have you. Par value is the amount of money of the bond, typically $1,000. Coupon rate is the interest rate. That is how much money you are being paid while the loan is out. Maturity date is the life of the bond, the length of the bond, the term of the bond. How many years? The stickers for bonds, the ticker for bonds is the exact same thing as the ticker for stocks. All right. You're going to get the same amount of information. You'll have the bond name. Again, this is a corporate bond. So you see Walmart Stores Inc. and Walmart has thousands of bonds out. You'll see the coupon rate, how much interest you're being paid. You'll see the maturity date, again, how long that money is being out for. You'll see the price. Now, I do need to point out, since I just told you that bonds are sold in $1,000 increments, yet we see 105.52 listed here for the price. The price of bonds are typically listed as percentages. So 105.52% of $1,000 means that bond will cost you, you can see down here at the bottom, $1,055.20. Even though the bond is for $1,000, sometimes you can buy bonds at significantly cheaper, lower prices, $800, $900. Sometimes you buy $1,000 bonds at $1,200, $1,300. The reason why the price of bonds, or the value rather, of that $1,000 bond increases and decreases could be for a whole host of reasons. Perhaps you have a bond, you bought a bond at, let's say 7% interest, right? Our interest rates concurrently are increasing. Maybe you buy a bond at 7% interest, and all of a sudden the Fed starts lowering interest rates again. Maybe they lower interest rates down to 3%. Well, now you've got a bond that is paying 4% more than the current average interest rate. People are going to be willing to pay more than $1,000 to own that bond because they want to make more money on that higher interest rate. Thus, the value of that $1,000 bond exceeds $1,000. Maybe people are willing to pay an extra $100 to have 10 years of 4% extra interest. At the same point in time, for a long time, our interest rates were very low. So if you bought a bond at 2% interest and now our interest rates are 6%, no one's touching that bond. No one wants to buy that bond. The value decreases. Now, before you go and freak out, I have to remind you, doesn't matter what the value of the bond is. Doesn't matter if you're getting 2% or 7%. You're still getting the money. And at the maturity of the bond, you still get your money back, right? You're not losing money in bonds. It's almost impossible to lose money in bonds because you get your money back at the maturity date. The value, though, fluctuates. Again, bonds are traded just like stocks are. So the prices are going up and down throughout the course of the year, throughout the term of the maturity of the bond. But that's why the price fluctuates. If you got a high interest rate bond, your bond is very valuable if the interest rates decrease. If you have a lower interest rate bond, the value of that might decrease if interest rates go up. But again, no cause to panic. The only way you lose your money on a bond is if you sell it before the maturity date and it's not valued the same. But that's what would cause a change in values. Earlier in the week, we talked about evaluating different types of stocks, right? How do we evaluate different types of stocks? The same is true for evaluating bonds. Bonds comes with ratings, right? So we go back here, you can see the rating right here in the middle of the screen, the Moody's S&P 500 rating. Bonds come with ratings, right? Typically, we like to find our bonds that are somewhere in the A's, and every financial advising organization has a different set of ratings, but A's, the more A's, the better. All right. We get away from A's. Now we're starting to take on risk. And again, we go into bonds to protect our investments, to protect our money. So if we get past the B's, then we're taking on some risk, meaning, is this a new company? Is this a stable company? Does this company have trouble? Is there any chance this company will collapse and not be able to pay us back? That's what these ratings tell us. Okay. There are things called junk bonds. And again, these are the newest companies, unstable companies. They might pay 10, 15, 12% interest, but there's no guarantee that they're going to survive. And again, the point of bonds isn't to make a bunch of money. The point of bonds is to protect the money that you have. So we typically like to stay in the A's. All right. The government does bonds. Again, these are called treasury, right? These are treasury bonds, treasury bills, government bonds. All right. Just some lingo here. The difference in terms is based on the length of time that it's held, right? You've got bills, treasury bills. Those are bonds that are, 3, 6, 12 months. You have government notes, treasury notes. These are 2, 3, 5, and 10-year terms. And then we get into government bonds. These are typically 30 years. All right. Some bonds are inflation protected, meaning that the interest rate gets adjusted. It gets adjusted based on the consumer price index. Right. Consumer price index is this rating of how much things cost people to buy. Although it sounds great, the problem is the taxes on it are quite tricky. Right, because you are constantly paying an adjusted tax rate for those bonds. Muni bonds, these are given out by cities. All right, again, Minneapolis did muni bonds when they wanted to build US Bank Stadium. And again, junk bonds, we stay away from those. There are benefits and there are dangers to bonds. Benefits of bonds, steady income stream, right? You are getting that coupon rate, that interest rate throughout the maturity of the bond, plus you get your money back. Bonds typically perform in the inverse of the stock market. So our stock market's been a little topsy-turvy. Bonds are typically pretty good, right? When the stock market is bad, bonds are usually pretty good because, again, it's safe. Bonds, again, if you got a high interest rate bond, if you have a higher interest rate bond and interest rates start dropping, living the dream. Because you're getting paid more interest than any of the other bonds that are out there and that are coming out there. This is where you could stand to make a significant amount of money on top of the interest rate that you're getting, because if you sell it, people are willing to pay more than the $1,000. And let us not forget, you get your $1,000 back. You get your $1,000 and the extra money that they paid you for the $1,000, which is legit. Dangers. Interest rates go up, you're out of luck, right? You're kind of locked in. And again, you're not losing money, but you lose liquidity, meaning you got to leave that money in that bond so you're not losing any of your capital, right? It's illiquid. You got a 10-year bond at 4% interest and the interest rate drops to 2%. You either give up money or you ride it out for the next 10 years until you get your money back, all right? Bonds are often callable. Just like stocks are callable, companies can buy back their stocks. They can buy back their bonds. This typically happens when bonds are issued at a higher percent interest rates and then interest rates drop. The companies will buy back the bonds at the higher interest rate and then reissue the bonds at a lower rate. So sometimes these can be a little tricky if companies are buying them back, especially if you have a legit interest rate. And probably the biggest danger of all when it comes to bonds is the fact that they're illiquid, especially if the interest rates are all over the place. The only way you lose money in a bond is if you sell it before the maturity date. Because if you sell it before the maturity date, there is a chance that you are not going to get 100% of the par value. You're not going to get 100% of the $1,000 that you actually paid for it. That's kind of the big danger of bonds, is that they are a touch of liquid. But you have to compare it to, the cause of why. Why did you move your money into bonds? You moved your money into bonds because the market was all over the place, right? Maybe we go into a recession. Maybe we're in a depression, right? You're not going to be making any money in the stock market. So you moved your money into bonds to get a steady interest rate, protect your assets, right? Protect your capital. So if you take it into consideration through that context, maybe you accept the illiquidity of bonds, knowing that it would have been much more catastrophic, much more damaging to have just left your money in the market. Again, these are safe, at the very least safer. They don't come with as much reward. But again, it's a way to protect what you've already earned in the market. And again, we're playing the long game here, right? We're playing the long game. We're trying to protect as much of our present money that we are investing for future use. So bonds are something that we need to consider. This is preferred stock. That is for next week. Let me just review again here. Today, the rest of today and tomorrow, you are looking at spending an additional $50,000 of your capital into the market. Again, we want to have some diversity here. Big companies, small companies, defensive companies, blue chip companies, income stocks. Get it diverse, different industries, different qualifications. Every purchase that we're making, we need to be filling out the sheet. Now, maybe some of you have made some legitimate coin here in the last week. Maybe you're willing to sell some of your stock to buy something else. Again, if you're selling, you need to highlight sell. Tell me all about it. Complete the sheet. One of you needs to do this for the group. Make sure your names are on there. Some of you may want to buy bonds. I'm not making you guys buy bonds for our stock market game. In the previous 2 trimesters, it didn't work for us in the market or in the stock market game. It didn't add to our portfolio correctly. So kids, they didn't lose money, but they didn't get any credit for the money that they made. So you do not have to buy bonds. Next week, we'll get into preferred stocks and mutual funds. So next week, we'll be buying this other type of security. So that's all I have for today. Securities research form should be done by the end of the day tomorrow. I'll be back tomorrow. $50,000 should be spent by the end of the day tomorrow. And then tomorrow, you'll have some time to invest. We'll kind of get caught back up. I'll answer any questions that you guys have. And then Friday, we have our standard bills to pay. So hope you've had a good few days. I think it's supposed to be nice up there or up here for you guys. I think it's supposed to get in the 70s. It was the 90s. It's in the 90s again in Phoenix. So unless I get bit by a rattlesnake on the last day, I will see you guys tomorrow, or a plane crash, but that won't happen. As always, go Spartans.